Forecasts are starting to pile up for the stock market for next year. What are people expecting? What are analysts expecting for the market in 2025? But more importantly, what should you be doing with these forecasts? How often are they right? Should they change anything in your financial life? All that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. It's clickbait for me, guys. I don't know if it is for you, but obviously I'm serving clients and serving the team and wear a few different hats over here. But yeah, I pay attention to the markets, and anytime I see a headline saying such and such analyst or Wall Street firm is expecting X for the S&P 500, I click on it. I'm curious. What are people seeing? What are people thinking? And you might be thinking this as well, because we know the markets are complex. It's more complex than we can realize. And yet, is someone seeing something in all this information that gives them a clue, a corner on what is ahead? And so, yeah, we click on it. So those forecasts are coming out for next year, for 2025. And the first couple came out just recently, and they're painting another optimistic picture for the stock market for the year ahead. Take a look right here. Yeah, a couple Wall Street firms are expecting another 10.5% rate of return from where the stock market is about right now. So we'll see how these last few weeks of the market shape up. But around 6,600 is what they're projecting the S&P to finish at in 2025. So another 10% or so rate of return for next year. I don't know about you, but that makes me feel good. They're not expecting a big crash, but I guess it begs the question, as a long-term investor, what should you do when you click this clickbait and when you see these forecasts and say, oh, they're expecting this or they're expecting that? What should you do? Is that even helpful? Well, I've got 3 lessons or 3 reminders I'm going to walk you through, and I guess the lead into that is, well, let's just take a look at recent history to see, well, how have forecasters done at projecting what the stock market's done just recently. I mean, we can start by just looking at this year. This year, the stock market has had a fantastic year, just about blew everyone's expectations out of the water, but let's take a look. What did Wall Street expect? And this graph really illustrates it, that the stock market far surpassed expectations, both the ones that were sort of pessimistic and the most optimistic. The stock market in 2024 far surpassed those. And so, okay, well, again, I'll take surprises on the upside. So maybe it's just 2024. Let's go back again, recent history. We'll start at 2020, and I use this example all the time. Anyone in December of 2019 that predicted a coronavirus and pandemic and shutdown and the fastest bear market ever and all of that, anyone who would have predicted that, I would have said was crazy, and no one predicted it, and that's what we saw. And so of course the forecasts for 2020 were wildly off track, not even close to reality. What about 2021? Most Wall Street firms expected a strong rally around a 10% rate of return in 2021, and the market just crushed it at 28% rate of return in 2021, far surpassing expectations. So then 2022 happened, and the expectation was another 10% rate of return, another strong year. And in reality, it was awful, right? 2022, we finished the year down 18%, so far away from a 10% growth rate. But at the worst point, the market was down over 25%. It was a bear market in 2022, and really there wasn't a lot of optimism. And so that spilled over into forecasts for 2023, where, most Wall Street firms were a little more tempered in what they expected. In 23, averaging around a 3% rate of return was the forecast for the S&P 500. And 2023 just, knocked it out of the park. Over 20% rate of return. And then that gets us to 2024, where again, the expectations were strong, 10% rate of return. But again, there was a lot of, cautiousness heading into the year because of the election and whatnot. But over 20% rate of return. So what's your takeaway? What's my takeaway? 3 lessons, and you know these lessons. So I'm just going to say 3 reminders. And the first is, no one can predict the future. No one can, and certainly in the markets. They are just far too complicated to even be able to analyze some data and then extrapolate a conclusion off of that. If life was static, maybe you'd be able to do that if you were really, really good and really did your homework. But to look at data and extrapolate a conclusion, but then have new data enter the picture and now extrapolate that, new data, things are constantly changing, constantly evolving, that it's just impossible for anyone, no matter how smart they are, to analyze things and project out where things will be a year from now. So reminder number one, no one, even the smartest Wall Street firms, the one that you might think, they've got to have some information that just I don't have at my disposal. So what are they seeing in that information? No, they can't predict the future, just like you can't. The second reminder is, even if someone has predicted or guessed right in the past, it doesn't mean they're going to be able to consistently do so in the future. And guys, there are just countless examples of that. But the most recent one is one that I am, enjoy, is Michael Berry. He was made famous by predicting and anticipating the 2008 great financial crisis and the Big Short. He was one of the stars of that. And so, yeah, I do look at what he's saying and so on. And he sent a very ominous tweet. I remember seeing it. He since took it down. He took it down very quickly. But early in 2023, just tweeted one word: sell. And from 2023, the rest of 23, and thus far in 2024, he's been dead wrong, like just very, very, very wrong. So even those that maybe have been able to look at the tea leaves and say, yeah, I think this is going to happen, and end up being right, doesn't mean that if they've been right once, they're consistently able to be right. So the sort of second reminder is, even for those that have maybe have something in their reputation that, yeah, I got this right once, it doesn't mean that they're going to be able to get it right again. And then third, the final reminder, a reminder to myself, is that oftentimes these forecasts do show some sort of average rate of return. We expect that the stock market next year is going to be similar to what it usually does, sort of an extension of the existing trend. But we know, history tells us, that around 25% of all years in the stock market are negative. And yet rarely do these forecasters predict a negative rate of return. And so therefore, just even from that logic, we're able to conclude they can't predict the future, because they're not predicting negatives, and we know that negative returns will happen in the markets. So what do? As a long-term investor, you stay the course. You stay the course. You take these forecasts exactly as they are, and that is as entertainment. As curiosity. Maybe you can learn a little bit of something. Oh, they're expecting this rate of return because they see these few things. Oh, that's interesting. But as a long-term investor, you stay the course. If you were a day trader, that information might be helpful, but it's so long as a day trader. You're looking moment by moment or hour by hour. You're not forecasting for the next year. So even as a day trader, that's irrelevant. But as a long-term investor, a one-year forecast is irrelevant. It's just entertainment. You stay the course. Make sure that the investment strategies that you're using are consistent for your risk tolerance, your time horizon, really for your financial plan and the goals that you're saving up for. And then one of my favorite quotes recently is make sure in the short term you're pessimistic, and in the long term, you're optimistic. So that even if we do have one of those 1 out of 4 times where the market is really bad and you feel like, oh, if only I would have seen this coming, I could have anticipated it. Well, making sure that you've got a fully stocked emergency fund, that you're diversified, that you're not using too much leverage and that sort of stuff. Staying the course, being disciplined in the short term, so that any temporary setbacks, they don't cause too much concern, but you stay invested for the long term, optimistic for the long term based on your financial plan. So work with your certified financial planner on that. If you don't have a CFP on your team that can make sure that you've got the right investment mix for your financial situation, you can reach out to one of the CFPs on my team. You can find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.